Rachel, we've got three massive changes that are coming in the next few months. One of them the next couple of days in Australian property. APRA, it's been the talk of the town the last week about the changes and how far we can stretch our borrowing. So you're the expert on that. We're going to go deep into that little hole. New South Wales and Victoria are upzoning around town centres, which is exciting news for a lot of people that live close to town centres, and we'll talk about why and how. But then there's 2% deposit business. That's a small deposit and potentially a large loan. So we're going to talk about how that's going to roll out in the next couple of days with the help of the government. So I'm excited to unpack all these three major changes because they are going to impact the landscape of Australian property, I believe.
Absolutely.
Let's do it. APRA, the Australian Prudential Regulatory Authority.
And look, there has been a lot. APRA's been all over social media, all over the news this week. And I guess who is APRA? So they are a regulatory body that can govern things like banking institutions and super funds in Australia.
So they have a bit of power and a bit of say, don't they? When they can see that their little people over here aren't doing the right thing or need to maybe see from afar that, okay, this is the pattern that's forming, they can then implement some changes.
That's right. So just to take it back a step, what APRA have done this week is they've come in to say, we're going to put a rule in place. It's going to start in February, and we're going to govern how much the banks can lend as a percentage of their lending to people with a DTI of over 6.
So DTI being debt to income ratio?
Yeah, so debt to income. So how much are you borrowing comparatively to your income? Now, there's been a lot of people talking about, oh, this is a big blow to first home buyers. They handed us the 5% government guarantee with one hand, and now they're going to stifle borrowing capacity with another. But one thing I really want everyone to know is that first home buyers are not impacted at all by this.
So tell me why.
So DTI, debt to income ratio, we were talking about the number 6, right? That's the thing everyone's talking about. Well, there are no first home buyers at all. And we've run, in my office, as soon as this news came out, we ran so many scenarios to go, okay, let's look at every first home buyer scenario we can and what's their DTI. We couldn't get anyone over 5.5
right,
because things like the bank's calculators are in place now they would already be capped out serviceability-wise before DTI even kicked in.
Okay.
This has nothing to do with first home buyers and everything to do with investors.
Yeah, so this affects home buyers and investors. Like it's a blanket approach.
Yep.
But you're saying because of the ratios, the first home buyer on average won't be affected going in to buy their first home to live in or investment? Or are you saying...
Whether it be first home or investment, where DTI really kicks in is when people have multiple properties. And I'm not even saying one. I'm talking about, I would say 2 or more properties is really where it starts to kick in for DTI. If you're looking at percentages, there'd be a very, very minute number of people that don't have 3 or more properties that will be impacted by this change.
Yeah, and the percentages are extremely low around Australia, those that do have 3 properties or more, those capitalists out there, including you and I. Look, but in all seriousness, there are, I suppose, 2 types of people listening to this. Ones that are wanting to get into the market for the first time, the first home buyers that you've mentioned, and the existing homeowners, right? So either way, they're saying to themselves, how is this affecting me? And you're saying it's affecting those that are in the market that have multiple properties more so than anyone else out there.
That's right. And you've got to understand, they're basically saying to the banks, APRA saying to the banks, okay, investor lending went a little bit crazy. It's gone to 40%. So that's not where it's comfortable. So it was only a matter of time before they stepped in and did something. And this could be the first of many changes. So I think the thing that's really important to note is that if this is one change they're doing, and I think the banks are either going to say, or we might self-govern to stop APRA doing a little bit more. But the writing's on the wall that investor lending has to slow because it's at an uncomfortable level in the country. So they're doing some things to make that slow. But for your average person, it's not going to make any sort of impact For a bank, they need to look at the percentage of that kind of lending that they're doing.
Yes.
And they're going to need to put some things in place to slow it if they're over that cap. Now, I spent some time yesterday talking to different banks that we deal with to say, where's your DTI sitting now? And no one's concerned about, it's close to 20%. So they can still have 20% come in at that level. But what I would say is anybody who does hold multiple properties, it's time to check your lending. Okay, we'll get to that in a minute, but I just want to stay on this for a little bit before we go to what can we do about it. The changes have happened previously, right? So we've had sort of interest-only caps, we've had investor growth caps. There's been a number of changes over the years. APRA have stepped in numerous times. Do you see this as any different? Because I felt as though the changes almost did nothing to the progression of real estate in Australia. When I say progression, I mean growth, capital growth. Yeah, so the last time they stepped in, I guess they stepped in a couple of big times. 2014, they stepped in and said, okay, banks, you can't have more than 10% of your book at a certain level of investors or growth. And then they came in again and a few years later in 2017 and said interest-only loans need to slow. And that's when the rates started to differ. Do you remember when rates started to differ and interest-only loans were more expensive? That's because APRA put in a guardrail to say banks can only have a certain amount of interest-only lending. And how the banks have levers that they pull to kind of slow different types of lending, and they might use rate or policy as one of those. So in 2017, they tended to use rate. So they just jacked up the rates of the sort of business they didn't want. Yeah. And I guess if we look at history and what happened at those times, did it impact the property market hugely? No, it didn't. No. But were there a lot of clients that were caught up in it? Yeah. That they couldn't do things that they wanted to do? Yes. So go back to 2017 because that's, I think, a very different landscape to what it is today. In sort of 2017 to maybe 18, 19, we saw a lot of oversupply in certain areas and certain asset types. We're not seeing that anywhere in Australia. Well, very minor in Australia right now. So the landscape is extremely different, isn't it, this time around? So I'm just concerned, I'm not concerned, but I'm sitting here saying, well, okay, some people will be impacted with this, and they're focusing on the investor here to be able to try and pull the reins back. But I don't think it's going to change a thing. In actual fact, I think it's going to continue to grow. If you ask my opinion of what I thought was going to happen, I thought APRA would have stepped in before they released the 5% guarantee. I always thought APRA would step in. They had to. Investor lending was getting out of control, and that's not where the market sits. But that doesn't mean the market's going to slow. It means maybe first home buyers get a chance to get in rather than the investors coming in. So I was shocked that APRA didn't make a move before that 5% guarantee scheme came in, because all that happened is the investors just jumped in and bought a whole stack of property, and we've seen that over the last 3 months. They've gone so hard, the investors. Do I think it's going to slow the market? No. Do I think there's going to be people that are caught up if they don't, think about their strategy if they've got multiple properties? Yes. And we're going to get to that, and I can't wait to hear that from you. The housing approvals, listening on the way here this morning, down 6%. Yes. Right. So the government are not meeting their targets. They were never going to meet their targets. In actual fact, they're going backwards. Right. So that's the issue, right? The issue is supply. Yeah. So supply is not there. Demand's high. Is it the investor inflating the prices? Are you asking my opinion? Give it to me. I think the supply is the big issue. And so who's pushing the prices? Investors, homeowners, first home buyers, downsizers, upsizers, every other sizer? Well, investors play a part in that. And when investors are coming in at we saw those figures last quarter that investors were 40%. That's a little higher than they should be. If that pulled back to 30%, would it change the property market? No, it wouldn't, because there's a supply issue. Yes. So I don't think investors are inflating the market, no.
Yeah.
What do you think?
Oh, I absolutely agree. I don't think it's the poor old investors getting hurt here, right? Now, I shouldn't say poor old investor, like it's the multiple property investors, I suppose, but it's a government issue, right? APRA's angled the wrong way, I think, in the regulatory change that's going to be made is not going to change one thing.
Well, this will not change a single thing. Will there be some investors that need to sort out their lending? Yes. But will it change the property market? No.
No, it won't. Okay, so give it to me or give it to everyone, the whole world. If we've got a multiple property portfolio or even just one property, what are we doing? How can we safeguard ourselves to be able to give ourselves the best chance of continuing to move forward?
Well, look, from the feedback that I got from the banks, this one change isn't actually going to impact a lot. So no one's thinking, we're at that limit of 20% of these high DTI clients that they're going to be doing anything, hugely to try to slow. But what the banks will be thinking is, okay, we're in APRA sites. Investors are in APRA sites. We probably should start to self-govern before they pull in things like they did in 2017, which were really uncomfortable for us. So my opinion is this is just one thing of a start, and then other things are going to come into place now where banks might tighten up their policies, and we've seen it with the trust lending, to try to slow multiple investors. And when I say multiple investors, I really think it's looking at 3 and more. So, I don't think it's your average investor with one investment property needs to really consider this.
All right. So if I'm a multiple property investor with 3 properties and I want to go and buy a 4th, the big banks won't help me because of the new regulatory changes. Can I go to a second-tier lender?
Well, it's not to say that the big banks won't help you. We just don't know what those changes are. So we don't know how the banks are going to react yet. So it's really important to note APRA's come out and said we're going to govern how much new high-risk lending you can take. But we don't know what the banks are going to do yet. The banks will make those decisions over the coming month. So we don't know how that's going to look. Let's say the banks all came out and said no more high DTI lending. Let's say they were really crazy about it and said, we're not just going to cap it at 20%. We're not going to take any investors over a DTI of 6. Let's say they did that. There's still other lenders that aren't governed by APRA. There's second-tier lenders. However, generally, they don't have a rate that's going to be as competitive as the big banks.
So where there's a will, there's a way, you're telling me.
There's always going to be a will and a way, but you can probably put some strategies in place earlier to make sure that you don't have to take your whole portfolio somewhere that's going to be a high rate. Yeah.
Okay. So without naming names, the Liberties, the Peppers, those sort of
so they're not really governed by APRA, but they may make changes in line with some of the regulatory advice. And they may do that by self-governing. So we don't know what they're going, because they don't want to stand out and be doing something that everyone's seeing as what they're trying to work against. I also realise that they're in the game of lending money. They are. Everyone wants to lend money. The banks make money from lending money. They don't want to pull back.
No.
They are going to do what is going to keep APRA happy, but they want to lend money. The banks are open for business. They want to find ways to lend money. That's how they make their money.
Yeah. Okay. So talk to me about a situation where for a lot of investors, they are on interest-only terms because they can then deploy their cash savings to their owner-occupier, their offsets, or just increase their cash funds and stay fluid and liquid. What can potential investors do when they're looking at those interest-only loans going forward?
Yeah, so I guess if we look back to 2017, if I think about the biggest impact that happened when these changes came in and banks tightened their policies, and sometimes banks do this thing where they go too loose and then they get a whole lot of this type of business, and there's the government will come back and say no more of that, and so then they go too far the other way and they do a knee-jerk reaction and they tighten, and that's what happened in 2017. So banks just went, we need to stop this, and they went too far the other way, and there was a group of a group of investors in a period of time that really got stuck. And the big thing they got stuck with was when, you're an investor, you do 5 years interest only, and they came up to the end of their interest only term during that time and they realised they couldn't refinance. They couldn't extend interest only terms. That had never happened to them before. And people may have been forced to do things they didn't want to do, and that may have forced people to sell a property in their portfolio they didn't want to sell because they couldn't service their debt on the bank's calculators with the new guidelines.
So could they go to principal and interest? Could you straight away default to P&I?
You can default to P&I, but I know in my portfolio, if it all changed to P&I, it suddenly becomes very unaffordable for me.
Yeah, so that's the issue.
So I guess looking at 2017, and let's preempt that this isn't the only change that's going to happen. Let's preempt that whether it be APRA or the bank self-governing, some things will tighten. So I guess things that investors can do is look at their portfolio and think, if I've got multiple properties, what can I do? If I had 1 or 2 or even 3 years left on my interest only term, I'd probably think about extending that before these changes took place.
So would that be a full application?
It always is a full application to extend interest-only terms.
Yeah.
I'd also look at my cash buffers and think, do I have adequate cash buffers? If I was thinking of investing again, I'd make sure the deposits are free.
Yeah.
Because let's say you are forced, you talked about a second-tier lender. Let's say you are forced to go to a second-tier lender because you want to buy another property. Well, if you've already got the deposit over here at a major bank plus all your portfolio, you're not forced to refinance everything.
No.
You just can do the new purchase at the second-tier lender.
Yeah. Okay. So extend your interest-only loans to their maximum as soon as possible, and get out any equity that you potentially have in your portfolio as well, just to keep yourself fluid.
If that's your plan. So if you were thinking, I'm going to go and get a deposit next year, maybe you'd think about doing that before. I'm not saying to everyone get cash out you don't need. That's definitely not the message. But for me and in my own portfolio, I would be making sure that if I wanted to buy a property in the next few years, I'd get the deposit out.
Cool. Good stuff. Any finishing words on the APRA before we move on?
I just don't want any first home buyers to think it impacts them. I think that I had my team do so many scenarios about DTI, and even people, even if you had two people on $100,000 and they were buying $1 million home loan, which is more than most people on that income would borrow, the DTI is still only 5.2.
Yeah.
It's not. Yeah. Those sorts of people aren't going to be affected by this DTI limit. So I think some of the people worrying about it aren't the people that should be. And I think some of the people who should maybe be worried about it aren't thinking about it.
Do you think there's a lot of people in Sydney worrying about it because potentially the debt they're taking on is far higher than the rest of the country?
It still really impacts you if you buy. It's multiple properties. You have to have a lot of debt comparatively to your income before your DTI hits 6. And remember, APRA aren't saying the banks can have no DTIs over 6. Yeah. They're saying they can only have 20%.
Yeah. 1 in 5.
This isn't going to be the thing that worries people. It's the fact that they've made a move, and more may follow.
Good stuff, Rach. As always, cutting edge. All right, we'll take a break and then we'll come back with some development changes in New South Wales and Vico.
This Is Property is brought to you by Sphere Home Loans. Sphere Home Loans is a mortgage broker that helps our listeners all around Australia. So, if you want to get into your first home sooner, looking at upgrading, an additional property, or want your current mortgage reviewed, just search Sphere Home Loans or click the link in the show notes, and their dedicated brokers will be able to help you wherever you are. If you are, however, after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. That's moneypodcast.com.au and click Get Help.
All right. So this has been in the pipeline for a little while, but it only just got passed through a bill through the New South Wales government 2 weeks ago, I think, 3 weeks ago maybe, in respect to high-density housing around town centres right now.
So you know a lot more about this than I do. Can you explain to me what the change is? Because I've read it, but I probably don't understand it as well as you do.
So it's basically a low to mid-rise housing policy to encourage more density around major areas, right? As an ageing population, we want people to be able to walk to the shops and jump on public transport and have all of our amenities around us. That's basically the plan from the government. And I suppose New South Wales seem to be further down the track than Victoria at the moment, but they're both adopting some sort of policy around that. The devil's in the detail, as always, and local councils. I spoke to my local council yesterday, or ours, and they couldn't give me too much detail about anything really. So no disrespect, but that's sometimes how these things play out. But in short, and we're not going to go into too much detail, but in New South Wales, for example, there's 171 town centres that are nominated, and you can go on the website, New South Wales Government website, to check those, that have been identified as low to mid housing suitable to be able to build or to be able to change the developments to be able to build more properties within those areas, right?
So are you saying that if I had a block of land, I might be able to do more with it than I could do before? Yeah, correct. And it depends on the zoning, and there's obviously some requirements around it. Like I think there's got to be a 12-metre frontage, but what's happening is they're able to you're able to chop blocks up, and chop's a dirty word, but let's subdivide blocks into smaller lots than previously if you're in those areas that are 800 metres to a town centre. And there's a spatial tool on the website. You can check this address and whether it's in 800 metres. It's got to be by a road or a footpath, not just as the crow flies or stepping it out. It's got to be legit 800 metres. And if that's the case, it can be put through as complying development through council, which means it's not a full DA approval or process, which in some cases, if councils have been, if developers have been sitting in council for 18 months, 2 years, which I know definitely a lot of people have, this speeds up the process to be able to build more houses quickly. Is this similar to the change that got made? Do you know when they changed it that you could put a granny flat on a lot easier? Is this the same sort of thing? So you can just do a complying development means a quick start approval. So you could potentially do a duplex or a triplex as easy as you could do a granny flat? Yeah, correct. That's how I see it. And as I said, it's only very new, but when you're thinking dual locks, when you're thinking townhouses, it basically allows you to get through the process quicker as long as you abide by the state regulations that they've put in place. So this is going to mean that people can build more property. What's it going to mean for your average investor? What should they be looking for when they're looking at buying blocks of land or what they already have? Yeah, and so the first part of it is if you fortunately have a block within that area, anywhere around the state, one of those 171 town centres within 800 metres, your maybe not so much your zoning will change, but what you can do with that block will change, right? Yeah. So you might have let's say a 700 square metre block, right, that you've got a house on it, it's renting out, and you could technically, if the planning's correct and you abide by the regulations, you could put 2 Torrens title townhouses on that, and that's been the case for a number of years. With these new changes, you can subdivide as little as 225 square metres. 225 metres as the block that you can just cut off. So if you had a 700 metre block, you could put that into 3 blocks. 3 blocks instead of 2. And sell them individually. Yeah. So which is quite substantial. It's huge. Yeah. So what potentially then changes is everyone's onto this and now inflated prices in those areas, right? So the beneficiaries are those that have already got land in those areas already that have been sitting on it or maybe in the family for a number of years, and now
son and daughter get their hands on it and say, right, let's subdivide this into 4 lots instead of 3 or 2, which previously was the case. So, yeah, interesting change. And, I think, as I said, Victoria's still to sort of roll out what it exactly looks like down there, but stay tuned for that.
So New South Wales have rolled it out. Has there been something in Queensland?
I haven't seen anything in Queensland, no. It's just a New South VIC. Those who are a part of PIPA, Ben Kingsley from the Property Couch did a good webinar on that with Rob Flux, I think is his name, and talked about that in much more detail than we are today. But, yeah, stay tuned for that stuff.
So if you're selling a block of land 800 metres from town centre, maybe check on what these changes mean for you before you do that?
Well, yeah, absolutely. I mean, the unsuspecting seller better be careful. But also real estate agents, right? When you're mocking up some sort of advertising campaign for that property, you've got to change your terminology around what potentially can be done there with council approval. But that's the big one for me is your granny flat example, you're in some ways bypassing the local council because the state ruling regulations trump that.
Yeah, because when something's done under a complying development, it's a lot easier.
Absolutely. Yeah, it's almost a tick and flick, isn't it? What
would be your top tip for investors and how they can make this work for them?
Well, identify the centres and obviously look at those blocks that are suitable for a start. If you are looking to do some sort of development, it might be just a long-term buy and hold.
Yeah,
you might just buy this and rent it out, and generally just wake up in 10 years' time and do the changes or the development. But I think one thing to add there, like anything, is don't just go and buy something for the sake of a new policy. It's still got to work. Now, I don't think and I had a quick look through the 171 locations. They're not in the middle of nowhere. They're in built-up areas already. So housing affordability in that area isn't great to begin with, right? Because they're all prominent areas. So the affordability of buying something like that now and renting it out and land banking it essentially is probably going to be low. The yields are going to be quite low. So you obviously need to take that into account as well. But yeah, I think it's it does change the landscape of an area, doesn't it? When all of a sudden you've got, instead of having 2 townhouses, you've got 3 or 4 in the one block. It needs more car spaces. The roads are going to be busier potentially. Not everyone wants to walk 800 metres to the shops. They get in a car and drive, right?
Yeah.
So, yeah, I think there's a whole range of amenities that need to be potentially upgraded with these changes over the coming years. And local council may not have, they've been consulted on all this, but they may not have thought, hang on a minute, the sewer's going to be impacted, the power, the roads, the width of the roads, a whole range of things.
Yeah. So who are the big losers in this?
Well, the big losers are the locals that NIMBYism we call it, right? Not in my backyard. It's that I don't want to walk out the front door and see a block of townhouses or a major block of units right next to me. I grew up in this neighbourhood where it was all nice houses and I knew everyone's name and all these sort of things, whereas now it's just busy, or it's just a concrete jungle. I think they're the ones that wouldn't be too rapt about this.
Do you think, we talked about in the last segment, we talked about the big issue in the Australian property market right now, which is supply. Do you think this change will help in any way the supply issue?
I think it actually will. And I like this initiative from that point of view. Yeah. I don't like it from the point of concrete jungle, but I do like it from the point of speeding up the process. The process is too clunky. It's too slow. There's too many fingers in the pie, it's just a clunky process. So this complying development, this is the other thing that hurts NIMBYism, right, is the local, the next door neighbour basically has no say in a complying development. Whereas a full DA, they get to, we send some letters out and we get the customer feedback and put your complaints in, or your queries or your thoughts or your questions, and all of a sudden it goes round the table for 2.5 years and then the DA gets approved. None of this now.
Well, that was some of the issues that I heard with the noise when they started to do granny flats as complying developments, because the neighbouring properties never had a chance to say, well, this is going to impact my property.
That's right.
So now you could potentially have a block of 3 townhouses right next door that you have no ability to object to.
Yeah. Correct. Yeah.
Really interesting. Well, definitely keep your eye out for that. And what's the site again where people can check the block? I want to know what the town centres are, and I want to know what blocks are if I'm going to start looking around. Yeah,
so it's planningportal.nsw.gov.au is probably a good starting point. But yeah, New South Wales government, just Google New South Wales residential changes or whatever, and you'll be able to find that.
Good or bad change?
I think good.
Yeah.
Yeah, well, I think good from definitely a supply point of view.
See, I thought they would do things more to get people to move out. Like I thought they would try. There was things that the government have done before where they made it so attractive for first home buyers to build further out, and people moved out because they made it so attractive. It seems like they're focusing more inward this time rather than out. Yeah,
I think generally they want people to come in rather than have to build out, because it costs a lot of money to extend roads, extend services, and a whole range of things like public transport. I think it's much easier to bring people in. Yeah.
Well,
so
hopefully it's a positive change.
Yeah, we'll see. All right. So to finish, this 2% government assistance.
Yeah. So the 2%. So the 2% is getting thrown around a lot at the moment, and it can be misleading because there's a few different things that are 2%. But basically, what it is it's called the Help to Buy Shared Equity Scheme. So not to be confused with the 5% guarantee scheme. So the one that came in October is the 5% guarantee scheme, where the government guarantees you. They don't have any ownership in the property.
Yep.
They guarantee you, and you only need a 5% deposit. This is different. This is the shared equity scheme. It's being rolled out nationally on the 5th of December. It was trialled in Victoria.
So time of recording is the 3rd.
Yes.
You'll be listening to it. It's already
10th?
rolled out.
It'll be it will be rolled out. So it rolled out on the 5th. It'll be the 10th when this goes on. But it's saying the Help to Buy means the government own a share of your property. And we talked about this when it rolled out in Victoria. I saw a lot of clients benefit from this that would not have been able to get into the market otherwise, but it is not for everybody because you're owning the property with the government.
Yeah.
But you only need a 2% deposit. So let's just use an example. Let's say you're living in a capital city and you need $1 million at entry level to buy, but you can only really afford or service a loan of $700,000. You could do this with the government where they own 30% and you own 70%. You only have to pay for your 70%. So you only need to pay your mortgage of your $700,000, but the government have their 30%. You don't need to pay them rent for their share. And, down the track, you need to, when you sell, they own 30%, not of 30% of the value now, 30% of the value of what it is.
Yeah.
Now, like the 5% guarantee scheme, this shared equity scheme has a lot of rigid requirements around it, and people really need to read the fine print. So a few of my concerns, not of just this scheme, but the 5% equity scheme, is that it needs to be owner occupied. You need to live in it for the whole time that the guarantee is in place, or that the government own a share. So that can be really rigid. So I think about how many clients I've seen over the years that have gone and bought their first home, they've bitten off more than they can chew, and then they move home with mum and dad, and they rent their property out. That is one of the most common things that I see people do. Or they get a job transfer and they rent their house out. You cannot do that while this is in place.
So, somewhat controversial. People are going to do it because of what you've just mentioned. I lost my job. I can no longer afford to live there. Like, how's the tracking system?
It's tracked. We are in a system now where the government knows everything. I have had a client be audited recently on this Help to Buy from Victoria, and they had to show, and it was actually legitimate that they there was a tenant in there for a few months when they bought, and then they moved, but they had to show all of that documentation. And I think with everything that's linked up, it would be very hard to not. It'd be very easy for them to find out if you're not living in that property and it's being rented out.
But if I lost my job and I can't find another one, or I got a transfer, then you
need to and this is where I've seen this play out in the Victorian one. You need to sell the property, or you need to get somebody to rent a room. You cannot move out of that property and rent it out. Now,
it's going to be a debacle, isn't it?
The problem with that is, let's say you buy this property, and we've had a really good 8 years of property prices going up at a huge level.
8 or 80?
8, not 80. But let's say you bought a property right today, and let's say you bought it for $1 million, and let's say you did this 5% guarantee scheme, and you needed to rent that out in a few months' time, but you couldn't, so you had to sell. And let's say with agents' fees, you only walked away with $30,000 or $40,000, so you still haven't lost money. Yeah. But then that's not enough for you to go back in, because the second time you go into that market, you're paying stamp duty, and you don't have this 5% guarantee. Yeah. So I just think people need to really consider whether the guarantee, whether it's the shared equity scheme or this Help to Buy scheme where the government's guaranteeing it, you just really need to read the fine print and understand your goals for the next 3 to 5 years, and is this in line with them?
So you mentioned before on the $1 million property, you put in 700, they put in 300. Are they physically giving 300 to the bank? Like, is it our taxpayers funding this?
Do you know that I don't know how it works in the background? Yeah. I would assume that obviously taxpayers are funding it. Yeah. The government's owning it. They're banking that the property's going to go up in value and that they get there. And even if you just say you became partnered down the track, you bought this property on your own, you became partnered, and you bought the government out, you've still got to buy them out at what the property's worth the time. At the time. Yeah. So. And unlike the 5% guarantee scheme, this one is capped. So they're trying this with just 10,000 at the start to see how it goes. So they're definitely going to be trying it out and seeing how it goes. But I have had clients in the Victorian one that have found it really difficult when they've wanted to exit. Yeah, so, it's that whole, just really work it through before you do it.
And there's income caps, isn't there?
There is income caps. I haven't. So yes, there is income caps. Yeah. So it's not like the 5% one. Now I'm seeing a lot of stuff on social media that's saying 2% deposit for investors or owner occupied.
Yeah, it's not.
It's not. But what is creeping into the market is this gap finance. And it comes in at the top of markets all the time. And it came in about 8 years ago, where other companies go, well, we can probably make money from this. So we're going to fund the deposit for first home buyers. And so whether it be investment or owner occupied. But I just want generally that is where another company's lending you the deposit, and it's at a high rate and a shorter term. And they sell that to you by saying, when the property goes up in value, you can just refinance and get it off. Well, when that came in 8 years ago, a lot of those people were stuck for a lot of years before they could refinance and get it off. So that gap finance, when you see it, just really read the fine print of anything that's gap finance.
Absolutely. All right. So, Rach, rewind the clock. You're back into first homeowner world. Your income's less than $100,000, which is a single cap. You haven't got a major deposit to get yourself into the $1 million property where you want to live, because that's a location that you like and enjoy. You've got the government assistance program. You can put in 2% deposit, so that's great for you. But you can only lend 700, so you have to request approval, or you're basically going to do a joint venture with the government. That's one alternative. Or you say, right, I can lend my 700. I'm saving a deposit, a good rate. I'll go and buy an investment property somewhere else. What are you doing?
If I've got a 2% deposit, I don't have the option to buy an investment property somewhere else.
No, but we're saving quickly. So the deposit will come. Like, we're talking 6 to 12 months.
I would prefer to have 70% of a good asset than 100% of a poor asset.
Yeah, okay, good point.
So if I could choose, if I was living in, let's say I'm living in Sydney, and I could choose a one-bedroom unit in a high rise.
Yes.
Or I could do a really good quality townhouse and own 70% of it with the government. I'm going to go the government.
Doing a JV with the government.
I would do a JV with the government. But if I did a JV with you, John, rather than the government, you and I need to agree when I buy you out, and you and I need to agree when we sell. And also, if you're going to have 30% or 40% of my property, I'm going to guess, John, as an investor, you're going to want rent for your share if you're not living with me. The government doesn't want the rent.
No.
And you get to choose when you buy them out, and you get to choose when you sell. So that's the upside.
That's the bonus,
The downside is you need to live in that property, and there's other restrictions about income, and even if you've got savings. Like we had one caught with that Victorian one where the parents were going to gift them some money, but they couldn't because if they had that money, they would be not compliant with the guarantee. So you've really just read the fine print.
Got to read the fine print.
What would you be doing?
What if the government want to move in?
They can't. But if you have the property with me, you've got some rights.
True.
So tell me, if you're a first home buyer, let's say you're a couple, you're a couple living in Sydney, and your joint income's $160,000.
Yes.
And your only way in is to use this government guarantee, or you can move right out regionally. What would you do?
Move out regionally or invest out regionally?
Well, if you've got a 2% deposit.
Yeah. I have to live in it, right?
You have to live in it.
I have to take that.
Deposits, it's just that's the roadblock for so many people.
Yeah, I suppose there's so many variations of this, isn't there, in terms of circumstances in life, and it would depend what your work was and how reliant you were on the cap city, but I'd be going regional.
Okay.
And buying a stronger asset.
Yeah.
With that, but. Yeah, that's not for everyone. I've always looked outside the square with this sort of stuff. So, yeah.
Look, if I could choose buying with the government, or if I had the option to buy regionally, I'd still choose buying regionally if I had the deposit.
Yeah. Okay.
Yeah.
Interesting stuff.
Yeah.
All right. Time will tell how that plays out and whether those
will.
10,000 spots will actually be filled. So, yeah. All right, I think that is a wrap. So sort of tying it together, I suppose the APRA's cap is about stability and not overstretching.
Yes.
For homeowners or investors or whoever it may be. The town centre reforms that we mentioned, it's more about supply in the right places and giving people access to amenities. And then the Help to Buy is about what the government's been on about for some time, access to home ownership, which is eluding a lot of people, isn't it?
It absolutely is. So, there's a huge amount of schemes out there, and I think people just really need to understand what ones work for them.
Yeah, absolutely. All right, good chat, Rach. If anyone wants a home loan or a good broker, they can hit up Rach and her team at Sphere Home Loans. If anyone wants a decent buyer's agent, then, we've got an option for you as well at Envisage Property. Until next time, have a good week. Bye.
Any information given in this podcast is for entertainment purposes only, and you should seek your own property advice before acting on anything you may hear in this podcast. If you want to start or advance your property education journey, John Pidgeon's book, Sort Your Property Out and Build Your Future, is available where all good books are sold, or via the link in the podcast show notes. Opinions or comments from any guests on the podcast are theirs and not those of the hosts, the publisher, or their respective license holders.